And Peter, I've been reading your notes, and you are very critical, I believe, of Mr. Powell. What is going on here?
Well, there's just a very scattershot approach to monetary policy. They're very quick to throw money from the sky and ease, obviously during stressful times, and they are very, very slow and way overstay their welcome on that easing. So here you are with the most noteworthy thing from Powell yesterday is that they are going to be double tightening again. And remember, double tightening was what they did in 2018 when they simultaneously shrunk the balance sheet and raised interest rates. So here we are again. They are going to be raising interest rates and shrinking the balance sheet. Now, keep in mind, QE was specifically meant to ease financial conditions. In other words, raise stock prices, tighten credit spreads. So now we have the end of QE and then QT. So that then tightens financial conditions. At the same time, they are going to be raising rates, which directly impacts the demand side.
So, Peter, okay, but here's the real question. Do you believe that this is an effort to, quote unquote, normalize the situation, or this is an actual effort to tamp down demand, given the supply issues in this country, both in terms of actual supply chips and products and whatnot, but also labor?
Well, it's definitely a combination. And, the supply-demand imbalances, I know the Fed likes to say it's mostly on the supply side, but we've seen the Fed and fiscal policy have full pedal to the metal on the demand side. So that's how you're going to recalibrate that supply-demand imbalance is, yes, by tamping down on demand. I mean, look at the housing market, where prices are up almost 20% year over year. If mortgage rates were 4% instead of 3%, if the Fed didn't cut rates as much as they did and leave them there for so long, housing prices probably wouldn't have been up that much. So, yes, right. They need to tamp down on the demand side with
how
housing.
How much do you think Jay Powell cares about what the stock market is saying to him or not?
Well, his history is a focus on financial conditions. That's the third mandate. So while yesterday he needs to talk tough and deal with inflation because it's running at 7% and they still have rates at 0, and he'll say, yeah, I'm not going to necessarily worry yet about financial conditions. But if the S&P falls a lot, if high-yield credit spreads widen out a lot, he for sure will be then focusing on it. And that will then lead him to a fork in the road. Which path does he take if inflation still remains elevated at that moment in time? Will he try to defend markets, or will he continue on a path to tamp down on inflation? That's going to be an interesting decision.
And what do you think the answer is?
I think, unfortunately, initially, they'll focus on where the S&P is and where credit spreads is.
Shepard Smith here. Thanks for watching CNBC on YouTube.